Welcome back to another video, and in this video I'm going to show you exactly where to invest using data. Now, for those of you who don't know, I use a property research tool called HTag, and I advise everyone to use it because it's an amazing tool. What I do want to say is that a lot of this educational content is courtesy of Matt from HTag, who is the founder, and he goes into even more detail about these metrics as well. But I'm going to do my best to educate you on how to utilize some of these metrics that I personally find useful when investing in property. And as you can see in this map of Australia, there are over 5,000 different suburbs that you can actually choose from to invest into. And what you'll know is that 99% of those suburbs are absolutely rubbish. You need to pick the right suburb to invest to because location does 80% of the lifting within property. And if you didn't know, 2 months ago, I made a very similar video, but I didn't feel like I had the energy or charisma coming through that video, so I deleted it. And I've also updated it with more metrics to help refine your research and find the best suburbs that you should be investing into. And just before I start this video, if you have not already, make sure you pre-order my book. It's $9.99. It's cheaper than a KFC box. It's an absolute no-brainer. Make sure you go pre-order it. Let's get back into the video. And I want to start off this video by saying everything always comes back down to supply and demand metrics. When you start to scroll down, you will notice that there's a range of suburbs to choose from and there's over 4,000 entries. Now, we really want to narrow that down. And the way we do that is by adding various different conditions based on the metrics that we want to use. And once I select all the metrics that I want, I can actually filter down from those 4,000 suburbs down to just 17. That's a much more reasonable selection to do my deeper due diligence into. And when you put in these metrics, it gives you the very hot markets that have both rental demand and capital growth. But you may be wondering, what are all these metrics? I'm going to teach you. And ultimately, everything comes back down to supply and demand. So I'm going to teach you those first few metrics. The first metric is stock on market, and I set that to be less than 1. And the reason for that is because I want there to be minimal supply as possible. The lower the stock on market, the lower amount of supply there is, meaning there is more pressure within the market. Too much stock will indicate an oversupply, while as a little stock will indicate there is higher demand. In combination, we want to use the stock on market long slope, and we want to set that to 0. And you may be wondering, what is that metric? The stock on market long slope metric is an indication that stock is actually decreasing over time within that area. And that is very important for us because we want to be investing to areas where the supply is getting less and less. We don't want an increasing supply because an increase in supply is the enemy of capital growth. So we want a decreasing supply, and hence we set the long slope to 0. If we set it to 0.5, this could possibly indicate that the long slope is increasing. We don't want that. We want it to be decreasing, so we set it below the median line. So the next metric we look at is days on market. Days on market is how long a property takes to actually sell. And I like to set that to 40 days because that indicates to us it's a hot market. Less than 40 days means that properties are selling in just about a month and a half. Anything more than that could indicate it's a warm to cooler market. And once again, we want to have days on market long slope as well set to 0 because we want the demand to be increasing. And the reason we want demand to increase is because when there's an increase in demand and a decrease in supply, we will have capital growth. And as an investor, that's a wonderful thing because that's what we're aiming for. So that actually tells you about the supply and demand metrics. So all of these suburbs that you can see here, it's where the supply is decreasing and the demand is increasing. And if you actually cross-reference this with the current markets in today, you can actually see that a lot of them are regional Queensland, which is just about right. And you can see a lot of them are in Cairns, Townsville, etc. And just before I go any further, if you have not already, make sure you are subscribed to my private community. We have over 100 members all sharing tips, tricks, investment locations in this community. It's $35 a month. It's an absolute bargain. There's also a 30-day money-back guarantee if you don't find value, but I know you absolutely will. So make sure you go and join our private community. Let's get back into the video. The next metrics are telling us where exactly the property is in its property cycle, because property in Australia doesn't just average 7% every single year like a machine. It actually goes through property cycles where it grows 10, 20, 30% in 3 years and then starts to dip and do nothing for the next 5 years. That's why property cycles and property timing is so crucial. And the way we do that is in a couple of different methods. We want to look at price change in 1 year. and I set that to greater than 5%. And the reason for that is because I want to invest into markets that are actually already rising. When I look at another market like Bendigo, for example, we can see that the 1 year price change has been less than 5%, and you can see it's been flat for quite a bit of time. When suburbs are being flat for an extended period of time, we don't actually know when they will start rising again. And so we want to be investing into locations that already have some sort of proven growth. We want to set the price change of 1 year greater than 5. Some people like to put 10, some people like to put 15. I just like to put 5 to capture in as many suburbs as I possibly can. The next metric is price change in 3 years, and I set that to less than 60%. And the reason for that is once a suburb has grown over 60%, I have now lost hundreds of thousands of dollars. That's a lot of money. If a suburb has grown that much, it is very risky for me to go in and then invest in that area. And a lot of markets within regional Queensland would have risen by that much at this point in time. So we want to be really careful about investing in suburbs that have grown too much, because it could also indicate that they are no longer affordable for the local residents within that area. And I'm going to talk about that metric as well. But there's also one more metric regarding property cycles and property timing, and that's to look at price change in 10 years. Now, everyone sort of understands that property appreciates about 5 to 7% every single year over an average 10-year period. Now, while that is a commonly understood metric, it doesn't always operate that way, and I use this metric with a bit of nuance. Sometimes I don't even like to use this metric because it would have removed a lot of suburbs that I would have considered investing into. And what I like to do is set the price change to 90% or 9% per annum, because I want to capture as many suburbs as I possibly can, and then use my own logic and common sense about whether or not I want to invest in that area based on a whole heap of other metrics as well. The next set of metrics is talking about affordability, rental demand, and also vacancy. And I'm going to break down each one for you. So the first metric we're going to be looking at is the affordability index. And there's a reason why this is so important, and I set this to less than 35 years. If we look at Armadale, for example, in Perth, we can see that this suburb has risen over 107% over the past 3 years. Absolutely extraordinary growth. Congratulations to the investors who bought in the early 2021s. And if I start to scroll down, you'll notice there is an affordability index, and this says it's at 50 years. That means this location is no longer affordable for the local residents in the area. This could indicate the price has simply just grown too much. It could also mean that investors are now driving up the area, because if people or the owner occupiers can't afford it, then who can? It's most likely East Coast investors. So we need to be very careful about investing into areas where the affordability is no longer apparent, because once the investor demand cools off and the demand cools off within the area, we can either see house prices begin to stagnate or even begin to fall back. So it's very important we invest into areas where it's generally affordable. Now, one thing you will notice about the affordability index is that in capital cities, it's always above 35 years. I like to set the metric to 45 to capture in as many suburbs as I possibly can. So make sure you make that adjustment when you look at capital cities. Now, the next metric I want to talk about is the renter to owner occupier ratio, and I like to set that to less than 40. And the reason the renter to owner occupier ratio is so important is because every renter is equal to an investor. And if we have too many investors in the area, that means if all those investors decided to leave, it could cause house prices to either flatline or to fall. And also having more investors within an area could mean that there is increased competition, harder to raise rents. It also means it might not be as a livable area as people like to think, less desirable to owner occupiers. And therefore, I like to have as little renters as possible, so I set that below 40. Generally speaking, I like to have less than 30. However, to capture as many suburbs as I can, I set it to 40. Now we go on to the other metrics. And these metrics are important metrics, but they don't really fall under a specific category, so I'm going to call it other. And just before I get into that, if you have not already, make sure you go subscribe to my free newsletter. It's literally free. It's an absolute no-brainer. You would be an absolute fool not to be subscribed to it. So make sure you hit that subscribe button. I go through an investment location every single week and give you a detailed breakdown of what is happening in that area. Make sure you subscribe. All right, the next metric we're going to talk about is hold period and why that is important. And I set this to greater than 8 years. Hold periods indicate how long a person actually holds that property within a given area. And generally, the higher the hold period, the better. And a higher hold period will likely mean that there'll be less supply in the future, while as a lower hold period can indicate that there could be more supply in the future. So as an investor, I want to invest into locations where people are willing to hold on to their property, where owner occupiers are living and they're holding onto their property and are not selling off their assets. And I like to set that to 8 years. And the thing you'll notice is that when you buy into investor driven areas or markets that are very, very hot, you'll start to realize that the hold period actually starts to decrease a little bit. What is the next metric? And that is the building approval ratio. And I like to set this to less than 4%. And this is really important because building approval is directly correlated with supply. And the thing you'll notice about these regional areas is that they will have a lot of developable land supply. And so that means future houses can be built. And so we want less building approval so that in the short term, there will be minimal impact on supply. And so as long as demand stays high, then capital growth will occur. So we want to keep that building approval ratio to less than 4%. And the last metric I like to put is yield. And yield is a very personal metric. You have to decide that yourself because yield would dictate how much cost that you will have to fork out yourself. Some people like to put a yield of lower percent, of 3%, and you have to decide yourself what that metric is. I can't tell you what that is. So I like to put 4 or 5%. It's really up to you. All right, so you may be wondering, damn, that's a whole lot of metrics and I've narrowed down to too many suburbs. But the truth is, you have to play around with this. You have to get better at using these metrics. Sometimes for me, rental demand isn't important. So I will take off the rent change. I'll also take off the price change greater than 10 years. And as you can see, I've gone from 17 suburbs to 22. And I have more suburbs I can choose from. And once again, I don't want to go buy in hot markets. Okay, let me consider cool markets, for example. So I'm going to set this to like 60 days or even 70 days to try and find more markets. And as you can see, there's now 39 suburbs which I can choose from. And if you really begin to play with these metrics, you can identify different locations and suburbs and filter in more suburbs based on your investment profile and your strategy. This is a very simple way to quickly narrow down different locations. Buyers agents use this method all the time. So make sure you're using it as well and challenge them as well. And if you haven't already, make sure you are subscribed to my private community. And if you're wondering, what is the deeper due diligence that I have to do when investing in property? Make sure you check this video out.